I think the biggest piece of advice, we can riff off this a bit, meet your lenders early, tell them what you're going to do, and then remind them when you did what you said. It builds trust. Start early, build a relationship, build trust, and remind your lender or even your VC, any capital allocator, that you did what you said you were going to do.
Hi, and welcome to another episode of Raw Green, a show produced by OBI, your sustainability consultancy specializing in life cycle assessment, research, and green tech. Check us out at oneobi.com or connect with us on socials. Links are ready for you in the description. Ciao! Let's go straight into it. There are many impressive climate technologies being developed or already operating right now. We study them, we work with them, and we speak with them, both on and off the podcast. We always say that climate tech carries a double burden. It has to deliver environmental impact, but it also has to deliver financial returns. We keep saying that the green premium cannot be the default answer forever. If anything, the goal should be the exact opposite, the green discount, as we've seen in renewables. Clearly, it's not easy, and there is a major bottleneck between a promising technology and deployment at scale. And the bottleneck, it is not always fundraising, it is bankability. In plain English, bankability is when a climate technology becomes mature enough, de-risked enough, and commercially solid enough to access debt and serious capital. So, what do banks actually need to see? Deployment hours, certification, supply chain risk assessment. My firstborn, ready and excited for a third-degree interrogatory from me and Emma. Today on Raw Green, we're joined by Bailey Morrow, Managing Director at HSBC Innovation Banking. Bailey works across climate tech, deep tech, and growth companies, and she's here to help us understand how climate tech earns serious capital. Bailey, welcome to Raw Green.
Thank you so much for having me. Very excited to kick off the conversation.
Let's get into it, Bailey, because I still don't entirely know what the word bankability means. But as Francesco's been trying to teach me, startups, they have technology. It works. They go to a market. They prove it works. They get initial pilots and traction in the market. And in theory, investment should follow. But it doesn't tend to work like that. What, in your view, is going on?
Well, I think the first thing that's going on is every company is different and every company's risks are different. So I think the first place we should probably start is I think bankability means something different for every company. So there isn't probably a blanket term as much as I would love to come on this podcast and tell you that there is. And I think what we're finding in the market is that, especially in climate tech, it's incredibly vast. It's moving incredibly quickly, and capital and bankability and debt is not moving at the same pace. So I think you're seeing kind of a gap there. And I think if we take it back to maybe first principles, for me, it's, what has the company done or what do they intend to do to de-risk uncertainty? I think that would be my maybe definition of bankability. And I think the next layer is where it gets really complicated, which is, well, what does that mean for each company? And you can appreciate for some companies, it's to raise an equity round. For some, it's to hit a technical milestone. For others, it's to build a robust pipeline. And so I think some of the confusion in the market and some of the uncertainty is that everyone's journey is different. And in addition, then you layer on top of that is every lender's view of risk is different. So you almost have these two conflicting, things happening at the same time, which is unique companies and unique lenders are trying to find the perfect match at the perfect time. I think that is what we're all trying to solve. And I think that's kind of at the crux of this conversation from a bankability perspective.
That lines this up beautifully. Thank you, Bailey. And we'll get into each of those points in turn. But just as a point of context, HSBC bought out Silicon Valley Bank, which of course now is the HSBC Innovation Banking team. So you've been on both sides of this, the climate-friendly US focus, and HSBC not so known to be so climate friendly in its other operations, but now of course it's bringing this innovation focus to the market. What have you seen there in terms of understanding the different journeys and scaling points that have been different across the markets?
Well, I guess you could look at it in two ways. I think one is US versus Europe, right? Silicon Valley Bank started in California. That's where I started with Silicon Valley Bank many years ago, and I think what you'll find there, and this is probably regardless of the sector, but very specific to climate, is that everything moves faster. So you have a faster deployment of capital, which means you have faster growth trajectories for companies, and you also have a faster both willingness to, and sometimes just happens, failure, right?
Risk
And I think
propensity.
all of yeah, exactly.
Yeah.
So I think all
Yeah.
of those are very unique to the US. And again, I think not specific to climate tech, but across all of venture. And I think where that's helped is it's allowed companies, I think, to, do more with more, right? It's get to scale faster. It's get in front of corporates quicker. And I think that that kind of flywheel effect has benefited a lot of startups in the US. I think Europe doesn't have the same amount of capital. That's kind of a known point. But I think it's a combination of the maybe culture playing in, which is kind of the lack of wanting to fail, right? I think that's a big, Americans, we're really good at it. We're real good at failing and getting back up again. Not
Also
saying that
modesty.
Europeans are.
Yeah.
Yeah. Yeah, modesty. But I think that's something here. And then I think there's been this, I guess, kind of idea about a path to profitability or a slower journey that will make, probably in the long term a better business. But it's meant that access to capital, continued scaling, et cetera, is much slower than the US. So I think what you're
There's
seeing
also
is
bureaucracy
cultural
layer.
differences. Yeah, cultural differences plus speed differences plus maybe a potential lack of, wanting to fail differences. And all of those compound to, I think, make, the US and the UK quite different. The massive caveat is, I think, the last couple of years, Europe and the UK have taken massive strides forward. So I think that, back when I was in San Francisco, that the gap was wider. It's definitely closing. So I think Europe has made amazing strides to deploy capital faster. And then I think the one key piece now is just the regulatory framework and view from Europe on climate is so much stronger than the US. And I think that's a really important inflection point for Europe right now. The US has a lot of things going on, which we won't get into politics on this podcast, but that Europe doesn't have, its fair share, but from a regulatory and from a climate focused perspective, now is the time I think that Europe will start to, see maturation in the market. They'll see more capital being deployed because there is a much greater focus, a collective focus, on climate than the US. So hopefully that will either close the gap or even the playing field, however you want to call it. But I'm quite optimistic about what the next couple of years are for Europe.
Let's take a step back for a second, because this gap between the EU and the US obviously triggered some sort of pride also at the institutional level. EU Inc. Tried to push a little bit more onto the growth of in-house or on-land bred technologies, supply chain and whatnot, which is great. The problem it is that we've been talking about EU Inc. from the past 10 years. So and that it is something that obviously again highlights one more time the gap between EU and the US. However, we have what I think it is the perfect and best solution right in our hands to close that gap in terms of deployment of growth scale technologies, which is exactly what we're talking about here today, the bankability. If we have already in here available a TRL8, TRL9 technology that is been validated, that has got n number of ticked boxes actually on their papers, done, ready to go, but they are missing the capital to grow and attack the market with the hunger that they should and the firepower they should have. The knowledge of having legacy or non-legacy banking institutions to back them up, or even better, back their clients up with debt, whether it is project finance or any other of debt. Why are we not pushing that? That means not sending these companies into the US to dilute themselves, whether it is in a faster way, a more aggressive way, which I personally love, obviously. But we keep them in here. They grow the economy. It is, in several cases, we're talking about energy security, that obviously it is an immensely important topic. So why can we not push around this bankability? Because it can be the reason. We don't need more capital. We need to deploy it in a more smarter way.
Yeah, I agree. I think, and this is maybe something that I kind of experienced when I first moved here from San Francisco, is I think there is a lot of education still to be done on debt in particular, and bankability is a part of that. But I think we probably, one, need more podcasts like this, or case studies, or live, or CEOs talking about live transactions to really bring it to life. Because I think that there is just education piece or potential fear of debt as well.
Yeah.
You
That's
don't
true.
want something you don't understand.
That's very true.
And then we don't have enough people talking about it, therefore you don't get educated on it. So you probably end up kind of in a black hole of confusion, right? You're like, I don't know how to scale my company, but I also don't have the resources to figure out how to do that. So I think, it's probably incumbent on all of us to talk about it more and to start filling in some of those gaps. Because it is about bankability, but it's about the basics as well, right? What is venture debt? What is security? What is an interest rate? I mean, we probably could start from, quite, simple parts of a loan, but I think that's important. And I think we make an assumption that because we work in tech, potentially founders or investors are educated on this. And I think we need to talk about it more. And I think that's probably a big part of it, is the education piece.
There's a clarification needed here while I'm trying to get my head around the whole idea of bankability too, which isn't just about, we're not talking about getting a startup company to take on debt in order to grow. VC investments and various other things is still filling that gap. And that certainly is what they understand. Bankability is about being able to get loans to be able to expand that growth, or more importantly, as I now understand, your clients, your customers can get loans in order to buy your stuff. Now, if that's a big thing, if you're selling wind turbines, for example, this is really, really important. This is a standard thing. They're not going to just buy it with cash. They're not going to turn up and bankroll you the money. They're going to need the loan to buy your product. So bankability is not just a sort of a debt instrument for the actual startup itself to consider, but something it needs to understand in the ecosystem in which it operates to be able to sell its goods and services across international markets, from that date forward. So I do see that the blockage that we see in the scale right now is it falls right at that point, doesn't it? At that timeline where scaling is just stalling and companies are just not getting the deployment and ultimately, getting the impact that we need in the world in this space.
Yeah. And I think that hits on a really important point. That is part of the education piece. But I think that bankability and debt in general, just not for startups, is pretty opaque. I came on here and said, I don't know what the definition of bankability is to start. So you can imagine, because there is no standard definition, because no deal is exactly the same. There is that kind of just general uncertainty. But I think if we could educate on, I guess, how to take money as a startup, you then probably have a baseline for then how you work with your customers to take debt. So again, I think it could potentially be like a trickle-down effect, where the more we educate the founders and the investors at the front line, that inherently educates them on how their customers could then use debt and how they could think creatively about structuring potential contracts or prepayments or stuff like that, where they could have a baseline knowledge of debt, and that could actually impact how they interact with their customers. So again, I think it's kind of that front line, and that trickles down to the way they, I guess, ultimately end up working with customers and leveraging products out there.
I've got a new title for this podcast, Francesco. We should call it "It's the Economy, Stupid."
Yeah, we're gonna edit that. No, what I wanted to ask you, Bailey. Yeah, we are. What I wanted to ask you, Bailey, it is while Yeah, I agree with you. The matrix combination it makes it really hard to develop a standard like an ISO for bankability. Okay, makes it really difficult. However, we can let's start to go by grade and be a little bit more granular. For example, is there any climate tech sector where, for example, the path to bankability it is more clear today? Is it for energy? Is it for materials? Software, hardware, infrastructure? Is there an industry that you see, yeah, it's a little
Yeah.
bit easier here?
I would say, I think the easiest one to start with is probably software.
Okay.
And I think partially because of the way that revenues are contracted, companies have a robust pipeline. They have contractual revenue. It tends to be repeatable. Their customers are large corporates. Those are all de-risking points for a business that's very unique to software. And if you're a lender and you're looking for things like visibility on revenue, diversification of a client base, nice, well-structured contracts that your customers can't get out of, liquidity, software is really, plays really nicely into that because the way the business models are set up, it's repeatable and it's contractual. And that's something that an investor can lean into.
Software companies don't need too much debt, though, surely?
It's a different use case, right? For software companies, we're looking at lending on recurring revenue. And that's an amazing growth tool. So you could say, I have 100K in revenue. And if I had, if I could leverage 2 times that and I had 200K, I could onboard a new customer, or I could hire someone new, or I can invest in a product. So it's very much like a growth lever in that instance. So that's a whole conversation around kind of debt use case. But the debt use case for software is true growth, is leveraging revenue to lever up your balance sheet to make strategic decisions that are value accretive to your business. And that's why it's easier, dare I say easier. It's complicated in any situation, but it's never easy, right? But it's a different risk profile than a hardware company. So we see a lot of the lenders, especially from a climate tech perspective, looking at more like software-enabled climate tech because you can leverage that baseline understanding of enterprise software. And that's a really important kind of de-risking point that helps us lean in.
You just name it. Is that true that the combination hardware plus software, is it some sort of a hedging that makes you happy to invest into that? Or is it like a urban legend in between some very restricted environments?
Okay. In the grand scheme of, if we put hardware over here and we put software over here, this is in the middle. We understand that there's a hardware component, but we get comfort from the fact that it's backed by software revenue. So you kind of get a little bit of the best of both worlds. I think in that case, we like more hardware that's off the shelf, that's potentially has a higher resale value, higher liquidation value, because it tends to be that. And then the revenue is really what's sticky. That we can lean into. So on the spectrum, kind of as most comfortably software, hardware-enabled software is probably in the middle, and then pure hardware would be, potentially on the other side. But I will say the one caveat is for scaled businesses, lending to hardware is something that lenders are really comfortable with, right? If you have proof points and the business is matured, some of the assets that we could lend against have a very high liquidation value. One right now that isn't necessarily climate but adjacent is like GPU financing. That's exploded because the resale value of a GPU is exponential, feels like this point, right? So that would have been historically a hardware we've said, oh, we're not really sure. And now people are leaning into it. So there are aspects of hardware, but it's very, very dependent on what that asset is in particular. And that kind of, helps us decide how aggressively we can lean in.
It's really interesting that you're pricing assets. How does it work when you're dealing with sort of first of a kind solutions and assets that don't really have intrinsic value yet?
It's a great question. So for first of a kind or really early, lending that we're doing, we look at a couple things. One would be the liquidity in the business. So at that point, we're very focused on liquidity. We need the company to have enough cash to fulfill, whatever their building is. And then second, we're looking pretty closely at the offtakes. So the way to de-risk kind of early hardware exposure is to have an offtake on the other side with take or pay revenue or contractual revenue. That helps us de-risk that early spend because we know in the future there's very likely to be revenue coming from that. So again, it is again the focus on the revenue, and that is a really important part. And less about actual revenue, but visibility to revenue de-risks us at the early stage. So that's how we would look at something like a FOAK.
That makes totally sense, Bailey. And everything you've told until now makes absolutely sense, especially because we're talking about the climate tech side of it. What I really want to know it is when we're talking about the client of the climate tech. So I really want to buy this incredible recycling technology. Is there any sector that you see, okay, it is easier to finance this technology client side? And at what point the standing of the buyer has an impact? For example, if you have a buyer with an incredibly high, I don't know, credit score or whatever kind of metrics can be used, how that can be of help in creating that bankability trigger into the technology?
It's a great question. And I think the maybe first caveat I'll say before I attempt to answer that is I think it highly depends on the stage of the startup and where they're at in deploying. I think if you're saying this is the first buyer ever and the company has never sold anything, I think that'd be very difficult. Regardless of how good the credit rating of the buyer is, there's massive execution risk at the startup level. And we have to take that into consideration, right? So I think maybe if we take the early stage aside, because I think that's quite difficult.
Yes.
I want to come back to it though, because I do have a potential solution that I'll come back to. The later stage stuff is a little bit easier because we have a couple proof points, right? They've had a buyer before, they've sold, they've executed. All of those de-risk points of every time they sell or sign a contract helps lenders get more comfortable. What you can also do then is look at, I guess, the buyer in its own right and look at potential like buyer credit and other interesting solutions that will help kind of that buyer in itself. And it comes back to what you said, right? Which is it's really about the long-term credit of that buyer. So there are solutions out there that probably start to look more like project finance, less like what we do from a venture debt perspective. You also tend to start talking about SPVs, and it gets quite complicated with corporate structures. That's not the risk that we take at the Innovation Bank and my team, but we are seeing that kind of more and more on the mature end, because that's when we can see the project finance people step in. They leverage the buyer credit. They're less worried about the startup credit. Correct. And you can start to see those kind of become more of a plug and play finance solution. But I think the big question that we still all have is, that's great. We have a market for that. We still have a missing middle, which is what do we do with the really early stage ones who want help with the first customer? So what I think is really interesting, and I think we're quite, excited, is to potentially partner with public funds. So, we just announced today that we're a new partner for UKEF, so export finance. So let's say, for example, we have a UK startup, the buyer's in the US, that tech is being exported to the buyer in the US. We could leverage export finance that I don't think has been done before. So there are, there's super exciting kind of new solutions where we're having to think differently. We're both being challenged from a public and a private perspective from capital and coming up with creative solutions. So, we're obviously cautiously optimistic. We'll see how it goes. But I think that that's a great first step to actually having something tangible to fill the missing middle.
I like that a lot.
Yeah. I think we just announced it today. So this is like perfect timing.
Wow.
Bailey, just to come back round on what you were saying before about the difference between the US and Europe. Now we've defined what bankability is. Does this mean that this can be an international standard? If it's bankable everywhere, or do you see geographical differences already?
It's a great question. And I think that becomes more of a like risk tolerance on the lender than probably on the company. Because I think what we're seeing is, if you look at just the US and Europe, we have quite mature early stage lending businesses, right? We have banks that have been doing this for a while. We have private credit funds that are happy to lean in. So I think we're getting to parity between those two. I think the wider question when you talk about does this translate globally is, how does some of the amazing budding tech regions, how do those local players get educated? Right? Because they have to understand how to assess this risk, how to structure around it. We hopefully will help as a global bank in that, of course, but it takes time, to take everyone internally on a journey to say, you're used to lending to cash flowing businesses. Now you're going to lend to cash out businesses. That's quite a journey that, credit has to go on as an example. So I think we'll get there, but I don't think it's completely plug and play from a lender perspective. I think similar to how we've gone on the journey in the UK and Europe, other budding markets where we're seeing some amazing innovation need to also go on that journey. And I do hope, though, that if we come back to this education point, if we all have a UK startup that ends up somewhere else, that we have given them the tools to show up to that conversation in the best way possible, presenting what, hopefully we have helped frame as what bankable means, right? And I'm kind of jumping ahead, but I'm happy to go into some of those because I think that that's actually like really, really important is how do you prepare for these, right? How does this transition to, the next lender you talk to in a new region?
Well, there are certainly another couple of layers that whether you are a VC or you are a bank, you certainly need to take into account, such as the regulatory level, regulation, just environmental regulations changes across regions. So that is already the first layer. The second, it is policy and stability. I mean, kind of another important one. So yeah, it would be amazing to have an ISO for bankability. The reality it is that startups or let's say early stage climate techs, they don't need an ISO, but an idea on how to walk their ways towards bankability is definitely important. Let's pin this for a second. We will go back again into this. I told you it is a third degree interrogatory. We're not going to let you go anywhere. We kept talking, we have been talking quite a lot about the differences between EU and UK. But there is a third one, which is the big elephant, or say panda, in the room, which is China. And China doesn't have, let's say, some sort of breaks when we're talking about deploying technology. We've seen it across the spectrum, especially for anything that concerns energy. We've seen it with solar, we've seen it with wind, we've seen it with battery, hydrogen. And I want to give you this stat, okay, because it is absolutely incredible. So there is this group called the Mission Possible Partnership, okay? And I read this article, as of June 2026, 19 commercial scale industry projects worth the beauty of $43 billion, okay, reached the final investment decision. We're talking about already semi-validated technologies. And out of these 19 funded projects, 13 were in China. So is it the West still debating bankability or deployment in this scale while China is building? Because this is a major concern.
Yeah, it's a great question. And I should give this, it's not even a quote, but I should give this idea, credit from a podcast I was listening to. But I think what I find super interesting when we talk about China is I think they have the benefit of thinking generationally.
Yes, that's very
and
true.
that they can build for the long term. And I think our biggest Achilles heel in the West is the short-term nature of kind of how our regulatory bodies, politics, government are set up. Yeah. And I think for me, that comes back to the biggest difference because there's not a willingness. There's no lack of willingness in the West, right? We have smart people. We have the tech. We have all the willingness to do it, I think. I'm quite optimistic. I think we're just more short-term focused than China. And I think that to me, that's what comes down. That's just the main difference. I can't see anything else that's different other than that piece. Because I think you can't, with all the amazing tech that we've put forward, and in the US in particular, everything, raising capital these days, AI, I mean, we're at the forefront of it. You can't be any more innovative.
Yeah. I do like a lot what you said. Yes, you're right. It is a generational thinking. and approach. However, the speed of execution, Bailey, it is like a speed light of
Yeah.
speed, whatever. And I can give you another practical example, and I'm sure they're going to achieve it. Like 3-4 months ago, they released the new 5-year plan, and they are incredibly aware of the bottlenecks that the grid it is for the connection of new power plants. Doesn't matter the source, clean or not clean.
Yep.
It is a major problem. So they said, okay, we have to start to do microgrids. Let's build 100 commercially energy independent areas until 2030, and let's see how it goes. And they're going to do it because we know they're going to do it.
Yep.
So there is
Scale.
that execution thing, scale and execution. Brava, exactly. That it is mind-blowing.
There's editing there as well. I mean, there's a story. I'm trying to remember the numbers and I'm going to misquote them terribly, but let's not let that get in the way of a good story. They had something like 500 EV car companies in China, all new brands, all competing for the same market, all trying to do the same thing. And at some point, the government turned around and said, no, too many. And they cut it down to something like 250, 300. Somebody can correct me on these numbers. Overnight, just like that, which meant all of the expertise, the learning, the technology, the IP, everything about it then was flooded into those 200 or so companies that were left, which suddenly created this, confidence in the market. Let's be honest, that's bankable, right? You've just cut the market down to serve the same number of customers with fewer number of suppliers, and you've consolidated everything overnight. So speed and scale, there is just extreme. We won't compete with that in European fractured markets and American markets built differently.
Yeah, I agree. I mean, I think that's probably more of like a political.
Oh, it's totally political.
to go into.
We try not to go into the policy of it,
but
Not that democratic. Yeah.
Yeah. But yeah, and I think that's, we have to balance that, right? Which we have fundamentally different political systems, and that's going to drive a lot of their innovation and inhibit a lot of ours. But I do remain quite optimistic that the West has woken up to China's speed and scale and commitment to innovation.
I don't
and
think
so.
so.
I think that it's nice to have that benchmark, and now we know what we have to, kind of look as our North Star of what we need to be doing. So I'm trying to be more optimistic than pessimistic. I think a challenge is great. I'm excited to rise to that. And I think China is presenting that to the whole world. And I think we don't have a choice other than to step up to it. So I'm hoping it ends up being more of a catalyst that brings, people together, especially in the West and definitely in the US. I mean, talk about fractured market at the moment. So
Yeah.
I don't know. I think I'm taking it a little bit as a call to arms.
Yeah.
Right.
That
like a
would
call
be-
to
that would
innovation
be great.
arms
Yeah, call to
to
innovation
do
arms.
something
Beautiful.
different.
Yeah.
So
Yeah.
that's
Look,
my way of
le-
like circumventing the politics. I hope that was good enough answer
Very
without going
smart.
into all of it.
We can drag you back into it if you want.
We'll have to cut the section if I get into politics.
No. Let's not go there. What I wanted to ask you though, let's stick with the innovation side of it, okay? What I wanted to ask you is, we've been talking about bankability, we're talking about markets. Let me ask you a little bit more about HSBC Innovation. What do you guys do? And because you have kind of a interest for seeing from the outside, you act both as a VC and as a legacy bank, obviously. Can you give us a little bit the ABC on how you guys work, your work?
Yeah, I mean, I like to say we have like 3 pillars of value if I take it back to like the basics, right? 1 is a global bank, 2 is lending to stimulate growth, and 3 is being a global connector. That's it. I think the first one we'll leave off because banking should just work. I think it's our view. It should work globally. It should work seamlessly. Are we there yet? No. Are we going to get there? Hopefully. But lending is where we add value, right? Like this is where we step in and we can fundamentally help redirect the course of a company's trajectory, right? And coming back to the kind of the bankability stuff. And I think for us, we have this saying, and I think this probably goes back, I've probably been saying this for like 15 years. We complement equity, not replace it.
Okay.
And I think that's probably actually not even for debt, but for everything. Like we are a derivative of the venture ecosystem. Our job is to add firepower on top of your equity, right? Or help on top of your VCs and your board to make a connection. We want to be the additive layer that is the difference between an inflection point, right? That's kind of our fundamental goal. So what does that actually mean from a lending perspective? At the earliest stages, we're doing venture debt. So we would call that more of the runway extension, kind of world in terms of use cases.
Yeah.
We then work with companies to transition them to working capital, which is where it gets super fun because that is a very broad word that could mean almost anything, which is stuff like recurring revenue lines, inventory lines, accounts receivable lines. It's where we get really, really close to that business and their flow of funds, and we try to find places where equity is used inefficiently. And if we can find a place, we should look at debt. And then we transition all the way to, corporate finance, cash flow lending, project finance. So kind of, I think from a debt perspective is to start from Series A and go all the way through an IPO and beyond, right? Because at that point, they're going to be levering up quite significantly to support growth versus the other side where they're going to be using equity.
So you start to, let's say, act from Series A until IPO.
I mean, through an IPO, but yes, I think where we are looking for companies that have raised a Series A, and for us, that helps us de-risk the tech, right? It's we're not going too early. We do want to be seeing some proof points and what does good look like. Again, come back to bankability. That could be a TRL level, that could be a customer level, that could be a million things depending on what the sector is. And we also like to have institutional VCs in there, right? We I think are quite good after so many years of doing this at, diligencing a company, but to have other smart minds around the table is hugely beneficial to us. So looking for VCs who have experience in this space, who are kind of leading from the front, who have views, who are really bullish on the company is hugely beneficial to help kind of pad out our underwriting and our understanding of that business.
And I don't know if in your experience, maybe this happened, that the VC was willing to invest and you weren't, and sometimes vice versa. I was curious to know if there is something that VC can forgive that banks actually do not forgive. Is there something in particular?
I think for us, well, I think it's really interesting you bring that up. I mean, yes, we absolutely say, opportunities are not right for us, even though they might be right for a VC. That happens all the time. And I think for us, we have a fiduciary duty because we're lending deposits as a bank to make sure that we have a path to debt serviceability, right? We need to have visibility on the company's ability to pay us back. Fundamentally, that's how we're different from a VC. A VC can take a risk. Of course, they want their money back, but they're pricing that risk with equity.
Yeah.
We don't have that luxury, right? We have to prove to we have to prove to obviously our bank and the regulators that we're taking bets where we think the probability of getting repaid is high. And I think that's where we tend to divert. Yeah, a little bit.
Forgive. Yes.
We just can't take the same risk in every instance as they can.
Let me ask about deal flow.
Profiles.
Does this mean that you've got lots of companies queuing up wanting to, if they've got institutional investors sort of on their boards, they're in bed with them, and you're willing to get in? Does that mean you've got enough companies to be selective here, or where's the pinch point, the bottleneck in terms of because we see so many companies that may not have institutional investors, but they're still going to strive to be bankable. Is this going to be an issue?
Yes, I guess the helpful thing that we've done as part of our kind of underwriting is we've used the Series A as an important checkpoint, which I think, to your point, that validates how many companies make it to that point. So we already kind of have a natural gate, if you will. I'm sure there's a better word for that. That we just won't, we unlikely do something before that. So we're looking at kind of those that made it there, which, kind of in VC language would be those that have the highest probability of also making it to a B. So we kind of have these really important inflection points that qualify businesses for debt in our mind. It's not true for all lenders, to be clear, but for us. And we do have a lot of conversations. And I think the main reason why we don't move forward, or where we see like a pinch point or kind of a, misalignment, I guess, between what we're looking for and what companies are, is almost always around timing. And this is the great debate of debt. I want to give it to you when you don't need it. You want it when you need it.
Oh,
And
that's the
it's
same.
like
hash it
woman
out.
and relationship. It is
But,
always like that.
It's got nothing
When
to
you're
do
not
with
in a
women.
relationship, of course it does.
It's the same throughout the entire life cycle of startups.
Exactly.
Timing is
right. It's like the age-old problem. And we face that as well. And I think that's a really important pinch point where we either have companies who the cash is too tight and the risk doesn't, work for us, or they don't want to raise equity and want to lever up and we're not comfortable with that. So it's almost always around liquidity that we feel is kind of the starting point for conversations. I want to complement equity, but that means you have to have equity for me to complement. All right, I can't take cash out risk, again, coming back to the risk profile stuff. So I think that's the pinch point. It's the Series A is a great metric for us. If you don't make it to Series A, we're not going to lend to you. So that's a helpful starting point. And then it's really about, cash, understanding your financials and your levers, taking debt early to get the best price, and not when you're running out of liquidity, because the risk profile doesn't work for lenders at that point. That's equity risk. So it's like this. It's like this sweet spot. And that's frankly that's the hardest part for us to even sell in. Right? Founders will say, "Well, I just raised a Series A, got plenty of liquidity, so I don't need your debt."
Yeah.
And that's kind of the education piece that we have to do. Yeah.
But that's a mistake we all make, that we all arrive just at the last minute until you're strangled like this. Right? If you instead you keep that, let's say, relationship warm all the time, then it becomes also a more natural and easier conversation to have. I imagine also negotiation
100%.
at a certain point. Yeah.
I was thinking about, what advice would I give? I think the biggest piece of advice, and I'm probably jumping to the end of the chat here, but we can riff off this a bit, but meet your lenders early, tell them what you're going to do, and then remind them when you did what you said.
Yeah.
I'm going to go raise a Series A. Raise a Series A and tell them. It can be a random email out of the blue. It builds trust. Yeah. It builds trust with us. You said you're going to do something. You had the right team at the right time with the right product, and you did it. Yeah. That's an important inflection point. And I think for me that comes back to your point, right? Is start early, build a relationship, build trust, and remind your lender or even your VC, any capital allocator, that you did what you said you were going to do.
Yeah.
Yeah. That's fair. There is the risking. It is all about the risking, isn't it? Whether we're talking about the technology, whether we're talking about the relationship, I get to know you better. I'm feeling more confident to invest into you or to lend you some funds. So it is all about that. And the point is, are we talking about making let's say, when we're talking about investable or bankable for the matters, we're talking about making companies boring, basically, in a nutshell, like boring businesses. Right now, it is back into fashion to start to work boring. Boring aren't, by the way, they are incredibly interesting. But is it about that, to make the business boring, predictable?
In some instances, yes. But I think that there's this interesting like push and pull companies have to do, because you want to be boring for your bank, but exciting for your VC.
Yeah. Very good point.
And I wonder if there's a whole chicken and egg thing here as well, because, so many capital intensive infrastructure style companies that I know are waiting to get what bankability brings to them before they can even approach the Series A. That is just a massive cliff that they're facing anyway, is with regards to their relationship with their investors and their proof points, their milestones. But it now pile on the fact that you won't be bankable until you've got your Series A, and yet so much of what they need sits on the other side of that wall.
So we've seen this a lot in climate tech, and I think that and deep tech in general. So this is a really, really good point. I don't have a perfect answer, but the way that we're trying to solve that, because we hear it often, is coming back to maybe that relationship point, is we are looking and keeping an eye on seed stage companies, building a relationship with them early, so they have the confidence that if they do what they say they're going to do, I will be there for the term sheet. I'm sure there's caveats around that. It's not as straightforward as that, but you get my point. And I think, again, it's on, I think, us as lenders to spend time with those companies, build a relationship, give them parameters. If you do this, debt could look like that. I think that's really helpful, and it's about shining a light on that path and making it not so opaque and giving them a clear visibility on how this process works. And that's true for the investors. So we spend a lot of time with investors and we say, if you put this term sheet out, our debt could look like this. And that
So
partnership
this
and that
really
transparency
interesting
is like
question.
critical.
Do you think you guys can give the equivalent of a letter of intent so that when they're raising their Series A, investors, VCs that are coming in at Series A can see that the company, apart from having its Series A, is otherwise considered bankable and therefore it's going to unlock all of this debt for them when they get to that point as well? Is it possible to transcend the wall?
Potentially. I mean, the short answer is we do letters of intent all the time, right? Those are really important.
Oh, they do exist. Okay.
Yeah, we do. We absolutely do them because of this exact question. And VCs want to see it, right? They want more capital on the balance sheet to support the benefit. I think my maybe caveat or pause is I think going early presents other risks. Just more about where is the tech at if we don't have any information and it's quite early and the company just started. We're taking quite a potential reputational risk on that. So I think what
comes
I found
back
really
to your
interesting,
relationship point, doesn't it? Because then they're talking to you and telling you and updating you.
Yeah,
but they're not.
Yes,
they're aiming for that letter of intent, which is going to enable them to climb the wall, which is going to enable them to then be considered. This is good, mapping it out.
Yeah, and I think we would definitely do that if we had a relationship with a company and they were speaking to VCs who we know that we've lent alongside before, right? Like the common theme throughout this entire chat has been relationships.
Yeah.
We call ourselves relationship bankers. Like that's how important this is to be able to, I think, work in this ecosystem. And if I had a relationship with the company and I had a relationship with the VC and I'd heard from both sides that there was a high likelihood that a deal was going to get done, of course we would want to be a part of that. And of course, we would try to the best of our ability, give them parameters on what a debt deal could look like. But I think coming back to, I think there's an earlier point, I forgot which of you made it, but getting pulled in last minute with people we don't know for a deal we haven't had any visibility on is super hard for any lender. So again, it comes back to like often communication and relationship building at the earliest of, inception. Because you just never know when you're going to need that partner in the future. So you might as well know who's in your Rolodex. So you can go to them early and often.
Yeah,
Nice.
that makes sense outside of any financing world. If somebody you just met on the road,
all of life maybe.
Give me a drink. So no, I don't want to give you. Who knows you? Why?
Yeah.
Why would I? So look, no, it is. Yeah, you're right. There is a common denominator, which is definitely the relationship part. And I don't know if you noticed, but we're sort of starting to mold this bankability checklist, this very obscure or unknown ISO that maybe one day the three of us should develop. I really I really would like to let's say work towards the closing of this episode, considering that very important chunks of our listeners and the people that actually the three of us work with are in climate techs, okay, or in technology in general. So I want to close this episode asking you something that could help them enormously. We realize that there isn't a standard, there isn't a checklist, but if you were the president of ISO and were given charge to develop the bankability ISO, what would be your checklist? Because like for the relationship, you don't want to build that bankability at the last minute. You want to start to build that from the very beginning when you're validating or you're developing your technology. So I meant that. I meant what I said earlier. This could be the pivot to keep companies in Europe not having them to be diluted or going towards the Series B, C, all the way to Z. If you have a technology TRL 8 or 9 that works at Series A, why the hell should you not be bankable and get your client your technology?
Yeah, I totally agree. To answer your question, I think I would think about it in two separate ways. I think I've got kind of what does bankable mean from a financial perspective, and then what does bankable mean from more, I guess, of the relationship side, right? So, there's four things I would look at, right? I think one, and apologies, these are kind of repetitive, but I'll summarize them so at least it's concise. One is sufficient liquidity.
Okay.
Like, and I mean, 12 months. You have to
12
give
months
yourself
on
enough time to
Okay.
execute on the plan that you are selling to the market, right? Whether that's me or investors, you go to market when you have 12 months of cash, or go to lender when you have 12 months of cash. So, we are lending into potentially a growth scenario. That's my first one. My second
Okay.
is picking investors who are knowledgeable in this space and who have been through cycles.
The process.
We know it's not going to go right. Actually, 100% of the time it goes wrong. Like, a part of it goes wrong. Do you know what I mean? We live in a constant, state of, potentially running out of money. That is how this ecosystem works, and we need investors around the table next to us who understand that. And a founder should want that too. I think decide what your core KPIs are for your business and be super clear about them. There doesn't need to be 100 of them. Do 3 things, like really measure 3 things really well.
Champion. Yeah.
And then 4 is think a lot about the team and the time and the product. And those, for me, those things go together. Is it the right team at the right time with the right product? We call it the gut check. Like, do you trust in that team that they can do what they say they're going to do? So for me, those are the 4 things on the more financial side, underwriting, that we look for, that I think makes you bankable.
Is there anything else that's more practical on a sort of certification level, or being insurable, or anything along
so the only thing I was going to kind of lay over that, which I think potentially could come on the core KPIs. So it would be, if you're a company that would benefit from regulation, that should be a core KPI. I need to get regulated, tick. So I think it kind of maybe fits into there, just because the KPI is a bit of a catch-all. Whatever is going to drive value to your business should be one of your KPIs that you either have achieved or are intending to achieve, that will be a step change in value. And I think kind of overlaying all of that is, I guess our kind of theme is, do what you say you're going to do. Across all of that. If you say you have 12 months, hold your team to 12 months of liquidity. Don't burn through it. There's always exceptions to this, but you get my point. I think it's like really, lenders really like that. And it comes back to the point about, that's kind of like the boring side.
Yeah, make it boring.
Make it boring, but that's the financial part, right? Then you got to think about, okay, well, what is the future growth? So we look at some of the, I guess, more future looking stuff, which is, who are your investors going to be at the next round, and what does good look like to them? So thinking ahead, right? That's how you get to your North Star. Your North Star is what is going to be most investable in the future. So we talk a lot about what's your path to the next round? Who are they? Have you spoken to them? Are you taking them on a journey? What are they looking for? What does competition say? I think that's really, really important, because most of our companies are loss making. So we have to have visibility into the next round of funding.
Yes.
And I think then the next one is, who are your customers? You don't need to have them now. Who are they? Do you have the right team to get in front of those customers? Do you know how to run an RFP process? Have you thought about how to finance your customers? This is kind of the maturity of thinking about how to go from almost R&D and ideation into commercialization, which is really, really important for a lender. That's how we get visibility on revenue. And then I guess the last one, would be, do you have the right finances in order? So the initial point was about commercial. This is about financials. We don't need a company at a Series A to have a CFO unless they want one, but we do want to see the maturation of the finances, right? Do you have a CFO? Are you planning to get one? Do you know what levers in your business you can pull if you need to reduce cash? Do you know where you would invest if you had more capital? It's kind of that, again, that forward-looking but financial-driven view. And to me, those are if those come together, that feels quite bankable to me.
Yes. A big fact.
Sorry, I know there's a lot of points, but
no, I can imagine our listeners are going to be scribbling them down.
Less than a checklist to open a bank account right now, so it's fine.
Try to keep it, to under 10, I think. But hopefully that's helpful. Great. I mean, again, I think it's kind of about the boring. You want to be boring on the stuff that is financial, and you want to be exciting on the stuff that is value accretive. And you need to find a balance between that and how to tell that story.
Yeah. That's very interesting, and it does confirms, I mean, some of the legends we hear through corridors around. But nonetheless, I do see clearly there is a window open to bring more clarity across verticals. I mean, you cannot do in 45, 50 minutes a lecture around bankability, but you could still clearly give some sort of direction around that. It would be great to have, again, a North Star that says for energy, you have to do X, Y, and Z. And the specific energy efficiency, you have to do that. Energy production, you have to do these other things, and then so on. You move towards marine environment, recycling, whatever.
Yeah.
So it'd be great if we arrive to that wealth of knowledge, because that helps speeding up and helps both the banking side to build the relationship from the beginning. And we said multiple times the importance of that relationship, as
Yep.
well as the startup, as well as the new technology. So it has to be some sort of working together. Okay, it has to be a cooperative effort in order
Yep.
to reach a goal that we all want to have. Look, Bailey, this was a fantastic conversation. I'm going to throw this. I think we were able to make banking interesting during this chat. It really was interesting, and I think it's going to be useful for a lot of our listeners. So I thank you for this.
Thank you. It was a very fun conversation, and I do hope we made banking interesting. It can be. And it's really, critical and a great growth driver. So I do hope we've hopefully upskilled somebody. My initial point was education. So at least we can say we educated somebody out there.
It is critical,
Fantastic.
Bailey. It's so important. We can't move fast enough right now.
Yes, you are right. That's very true. Thank you, Bailey. Thank you, Em. And catch up soon.
Sounds good. Thank you, guys.
Thanks for listening to this episode of Raw Green. If you made it this far, you probably enjoyed it. So don't forget to hit subscribe and follow our podcast. It's an awesome way to support our community. At Obi, we're all about research, life cycle assessment, and the green tech innovation. Stay in touch through our socials or visit our website. Links are ready for you in the description. Catch you in the next episode. Ciao.